Hello and welcome to this session. In today's session, you will learn about the credit default swaps. In this session, you will learn about features of CDS, key terms, types of CDS, clearing and settlement of CDS, credit events, and CDS indices. Let us begin with a recap of fixed income derivatives. As we already saw, there are two types of fixed income derivative, both of which are OTC derivatives. They are interest rate derivative, which you already learnt about, and credit derivatives, which we will cover in this topic. So what is a CDS or credit default swap? A credit default swap or CDS for short is an agreement to buy protection against a credit event on a fixed income underlier. The protection buyer makes a upfront or series of payments known as premium to the protection seller to buy protection against default or other credit events in the reference entity. The protection buyer and the holder of the debt also has a reference entity for the example. In the form of bond, there will be regular premium for the tenure of the CDS or until the credit event occurs, whichever is earlier. In event of default or credit event in reference entity, the seller of the CDS will compensate the buyer. Now, what is a credit event? A credit event is any reduction of creditworthiness of a debt instrument. For example, government securities as mentioned on screen. Examples of credit events include rating, downgrades, bankruptcies and corporate restructurings. We will learn more about credit events in much greater detail in this module. The protection buyer and protection seller are mutual funds, pension funds, security firms, banks and sometimes even governments. Though the percentage of government and participation is only 2%, buying of protection is done to get insurance against any risk associated with the market, whereas sellers bet against the market risk and want to make profit on the premium received. A CDS is similar to an insurance policy, but it is not subject to federal or state insurance regulations. The protection buyer, who need not own the underlying bonds, pays a quarterly premium to the protection seller. In short, the CDS is an instrument to transfer the credit risk of an asset without transferring its ownership. Moving on to the risk involved with CDS trading. The buyer of CDS protection bears most of the risk of the swap, because the main risk of credit default swap is that the seller of protection is unable to pay in the case of credit event that is covered by CDS contract. In other words, while a credit default swap is supposed to protect the buyer of the CDS from credit risk of the reference entity, it does not protect against the credit risk of the CDS seller. Furthermore, if the CDS seller defaults, then the CDS buyer suffers losses from both the reference credit event of the reference entity and from the loss of premiums paid to the CDS seller. Hence, a CDS seller must have top credit, and if the credit rating of CDS seller declines, most CDS contracts require that the CDS seller post more collateral to protect the CDS buyer. This is what precipitated American international group's free fall to inevitable bankruptcy before the United States government bailed it out with $85 billion loan. It seems that AIG had a small department that sold only CDS protection. Evidently, the traders in this department considered the premiums to be virtually free money, since they did not hedge their own risk and they sold a lot more protection than what they could actually cover. Worse still, most of the protection was for mortgage-backed securities based on subprime mortgages that started defaulting in significant number in 2008, causing the credit rating agencies to downgrade the credit rating of AIG, which by force of contract required AIG to post more collateral for its credit default swaps. Alas, it became acutely obvious that AIG didn't really have the capital to cover all of its CDS buyers because of danger of credit contagion. Credit contagion is a significant risk to any economy of credit default swaps since by their very nature is a failure in any part of the buy and sell chain can cause more failures of other institutions with their own cascading effects. There are three types of CDS. First is single name CDS, where it considers the debt obligation of only one company as its reference obligation, for example, any debt instrument paying its regular income. The next type of CDS is called portfolio or basket. It considers the debt obligation of more than one company and its reference obligation. And last type is known as a naked CDS. It is when the buyer of protection does not hold the debt obligation. Typically, they bet on a reference obligation which they do not own. Let us go a little deeper into portfolio CDS, which is one of the major types of CDS. In a portfolio CDS, the protection is bought or sold on a basket of underliers or group of indices. The protection buyer transfers the credit risk to the seller on a basket of underliers. The protection seller is exposed to the size of defaulting underlier rather than the size of the basket. The popular versions include first to default. Here the CDS payout occurs when the first underlier defaults. Whenever an entity in the reference basket defaults, the buyer stops paying the swap's premium and receives from the seller the difference of principal amount of the defaulted entity and its recovered value. The next type we have is nth to default. Here the n is specified in the contract. Whenever the nth default occurs in the reference bucket, the buyer stops paying the premium and receives the difference of the principal amount of the latest nth defaulted entity and the recovered value. In some cases, even if there are defaults on entities before the n, the swap continues till the nth underlier default. For example, if there are 10 reference debt obligation, protection buyer absorb losses arising from the first 9 defaults and receive compensation only after the 10th obligation defaults. The last type is all to default. Here the CDS payout will take place when all the underliers default. If there is a high correlation between the underlier, then the premiums generally fall and vice versa. For all to default swap, the buyer continues paying the premium as long as there are undefaulted entities in the basket and the counterparty does not default and receives from the seller any lost principal amount of the basket. The recovery rate is the rate that the protection buyer can get from the market in case of default. The protection buyer will receive cash equal to the recovery rate, which is basically indicating the worth of the underlying asset. The recovery rate enables an estimate to be made of the loss that would arise in the case of default. This is calculated as 1 minus the recovery rate, which is published. The loss given is the default amount that protection seller will be paying to the protection buyer. Let us understand this by taking an example. If the recovery rate is 60%, then the loss given default or LGT is 40%. On a $10 million debt instrument, the estimated loss arising from default is thus 4 million. Let us take one more example on this. The recovery rate published is 48%, which means LGT is 52%. A bond has a notional rate of 500 million and hence the loss from investment is $260 million above the calculation in the slide. So for bond A, in case of default, the protection seller will be expected to pay $260 million. Moving on to the survival rate. The survival rate is the rate or period that the company will survive in market. It has an inverse relationship with the premium payments to the seller. For example, in case of a bond which has junk status, chances of it defaulting is much higher, which means chances of it surviving is low and hence premium payment will be higher. Once the protection buyer has actually brought the protection to safeguard from the loss and remaining cash balance is known as survival rate will be paid by protection seller. The table shown on the screen mentions the average premium of CDS against the bond spreads in terms of basis points. Bond spread is defined as the percentage difference in current yields of various classes of high yield bonds, often junk bonds, compared against investment grade corporate bonds, treasury bonds, or another benchmark bond measures. Hence, to conclude, as per slide, we notice that the average premium of a junk bond is higher than the spread on a bond which earns relatively lower returns on investment. That is, lower yield bond will have lesser premium. Here are some more key terms associated with CDS. Many of these you have already learned in the topic on interest rate swaps. Trade date and effective date in CDS can be the same or different, but effective means the date from which the protection seller will provide protection to the buyer. The credit events are the events applicable to CDS contract. The term indicates the time period of a swap. It could be 2 years, 5 years, etc. The termination date is the last reset date of the swap. The reference obligation notional is the notional of CD's contract that is paid by the protection seller to the protection buyer. Continuing on with some more key terms, we can easily understand most of the terms by their names itself as we have learnt about them in the earlier sessions. Moving on to the pricing of CDS. The screen shows the pricing of some CDS along with the spread, perceived risk percentage change and basis point change. Finally, we come to the clearing and settlement of a CDS. The clearinghouse acts as the central counterparty to collateralize the clearing obligation of the counterparties. The clearinghouse is working with a group of CDS market participants on creating a clearinghouse for credit default swaps. This clearinghouse would essentially act as a central counterparty to its participants, guaranteeing all CDS transactions accepted for clearing and collecting margin and other credit support from its participants to collateralize their clearing obligations. The clearing corporation will begin by clearing trades on North American CDS indices. After the service operational, European indices, index tranches and single name CDS transactions will be added. Participation in the clearinghouse will be open to all qualified clearing participants, both dealers and non-dealers. In order to qualify as a clearing participant, a firm will be required to satisfy the clearinghouse participants criteria. According to the clearing corporation, these criteria are currently expected to include the following requirements. Minimum net capital of $5 billion, minimum long-term debt rating of A from S&P or equivalent from another nationally recognized rating agency, demonstrated operational competence in CDS, including positions having a minimum outstanding notional contract value of $500 billion, demonstrated risk management capabilities, and participation in CDS industry organizations such as International Swaps and Derivatives Association and DTCC's Derivatives or SERV. Let us look how a CDS is settled. A credit default swap can be settled either physically or by cash. Most credit default swaps are in the bracket of $10 to $20 million range with maturities between 1 to 10 years. 5 years is the most typical maturity of a CDS. A physical settlement is when the protection buyer sells the bond at par value to the protection seller, or when the protection buyer sells the financial instrument in the market based on the recovery rate, and any remaining amount over and above the market price is reimbursed by protection seller. In case of default, the reference obligation will have to be sold by the protection buyer in the market, which is the method used in the physical settlement. Now, since the reference entity has defaulted, the reference obligation which was issued will lose its value in the market to what it was when it was issued in the market. This means it cannot be sold at the same price at which it was issued in the market. So we consider the recovery rate. So you will recall the recovery rate is the rate at which the protection buyer can get from the market in the case of default. The screen shows that total capital market outstanding in terms of value is approximately $57 trillion, which includes both stocks and bonds trading. Whereas CDS alone has $38 trillion outstanding in terms of value. This clearly indicates the growth of fixed income derivatives and CDS in particular.